In this video, we're going to look at a beginner's guide to leverage. Stay tuned. Hey traders and investors, a very warm welcome to you. Okay, so this short video, kind of a beginner's guide to leverage or leverage, wherever you are in the world or however you pronounce it, it doesn't matter. What we're going to look at is how it applies to the financial markets. And I'm going to use an example of buying a property because it's very, very similar to illustrate the point. Okay, so let's get going. Right, example here, we have a house, nice house, you want to buy it, it ticks all the boxes, it's great, and it's £300,000. Unfortunately, you don't have £300,000. You only have £100,000. So what do? You go to a mortgage broker or a bank and you say, excuse me, Mr. Bank Manager, I would like to buy this lovely house. It's £300,000, but I only have £100,000. Would you be kind enough, sir, to lend me the additional money I need to buy this property? And the bank manager says, let me do some checks. He goes away and he makes sure the house is worth £300,000. He makes sure the land's correct. He makes sure it's not going to fall down. Does all those kind of things, which comes from a survey generally, or more likely just drives past the thing. He says, hey, are you credit worthy enough? What's your job? Can you afford the repayments? Blah, blah, does all the risk analysis, fine. And then says, sure, no problem. I will loan you the extra £200,000. It will cost you 3% per year and you've got to pay back the interest plus the capital, and the repayment is going to be X pound per month. And you go, great, thank you very much. Sign on the dotted line. You buy the house, it's secured against the land, it's secured against the asset. They basically own the house and you have 100K worth of equity in that. Now, what happens if the house price goes up to £400,000? Okay, let's say the house price goes up to £400,000 a couple of years later, whatever it may be. What happens then? Well, ultimately, you make the difference between the 300 and the 400, i.e. you make your 100K. So you've put down a 100K deposit, the house price has gone up by £100,000, you've doubled your money effectively. Yes, you've been paying payments to pay down that 200,000 loan in that 2-year period, whatever we just said it was, but the bank doesn't own any of the gain from that. You are just paying down the capital secured on that. So that's the important thing to know. Vice versa, you know, if that house price goes down to a 200K, the bank doesn't lose any money. You're the one that loses your deposit, because if you then sell that house and you sell it for 200K, the bank still wants their 200K back minus anything that you've paid in between. You're going to lose your 100K deposit. So that's pretty much how it works. But the bank allows you to buy something bigger than the 100K you've got. And obviously that number could be adjusted wildly. We could say, hey, you only have to put down 15K, 5%. You get more leverage, it's going to cost you more money. You get the idea. Now let's have a look at it in the trading world. So the trading world, similar kind of thing. We want to buy an asset. Let's look for example, we want to buy the FTSE 100 and it's currently trading at 7,000. This could be gold, could be oil, could be a currency pair, could be anything. The point is, it's an asset and we want to buy it through a spread bet or a CFD, or even if we're going to futures contract, but let's just keep it spread bet and CFD because that's easier for us to understand. So we buy the spread bet or CFD and we go and we say, okay, I'd like to buy £10 a point or 10 CFDs of FTSE 100. The notional value of that is going to be £70,000 because we're buying 10 times our 7,000, 70,000. If we buy £100 a point, it will be £700,000. There's a notional value calculated for everything that we're buying, and we use that to calculate the margin, the leverage that we're going to use. We'll come to that in a second, but that's an important thing to know, and that comes from the value of the asset you're buying and the position size. Obviously, the higher the position, the more the notional value, the lower the position, the lower size of the asset, etc. So we have a notional value of £70,000. Our broker will then say to us, no problem, you don't need to put up £70,000, sir. You can, because we think the FTSE 100 is a pretty stable thing, we don't think it's going to go to zero tomorrow, and we have a lot of people exposed long and short, so we're kind of almost market neutral on it. Our risk isn't that great. We've already assessed, you've already got some deposit in your trading account, and that is going to be £350 because we're asking for only 0.5% deposit to use that much capital to buy this. And we say, yeah, no problem at all. So you're effectively borrowing that additional £69,650 from the broker. The broker's saying, hey, you know what, I'll lend you that and you can buy this FTSE 100. And he says, you know what, the rate's going to be 3% per annum. You've got to pay it daily though. So every time you hold that overnight, you need to pay daily. Now, what happens? We are now in control of £70,000 worth of FTSE 100. If the FTSE 100 goes up to 8,000, let's say, over a period of time, and let's put it down here, that valuation now goes up to 80,000. Okay, we have made £10,000 on our trade. we make that £10,000. The broker has received the payments that we've made on the overnight charges, where overnight charges come in to pay to borrow that additional money. So we've paid that, but we've made the difference between the initial and the 80,000. However, if we take the trade and it goes against us, in this case we've got quite a low deposit. If it goes against us by 35 points, we're going to be wiped out. Our deposit is going to be gone to the broker. Way before that, actually, the broker will say, hey, you know what, we need to cut your position. You have no more deposit unless you want to put more funds in. You could put more funds in to fund it, but that's that. So the point is, you're using leverage to increase the amount of money you'll make when you're right, but also increase the amount of money you'll make or you'll lose when you're wrong. So similar as if you're buying a house here, and if you're trading a FTSE 100 here. Now, banks are going to loan based on an individual asset. Brokers are going to loan depending on how they consider the risk of the thing that you're buying. If you're buying a small biocap stock, for example, they're going to want probably a 50% deposit because that's pretty risky for them. If you're buying a FTSE 100, you're buying the Dow, you're buying GBP USD, you're buying US dollar JPY, the deposit is going to be quite low. I've made that number up 0.5%. It's going to vary from kind of broker to broker. The point is, it's how much they're allowing you to put down, how much leverage you're allowed to use. So you might have noticed now, it's a double-edged sword. The more leverage you use, yes, you can control more money. You can control millions, in fact, for a very small amount of capital, which is fine, which means if the market goes in your direction very aggressively, very, very quickly, you're going to make a lot of money. But vice versa, if it goes against you, you are going to lose a lot of money. Now, the big difference, of course, between this and this is that, hey, you could buy a house and you could be leveraged right up. The house prices could halve. As long as you can afford that monthly payment, that doesn't really matter. You're not forced to liquidate that property as long as you're paying your monthly payment and mortgage. Now, obviously, there's terms and conditions and they can pull the mortgage at any time. But fundamentally speaking, you don't have to liquidate that. However, when you're using leverage with a broker, if the market goes against you, the broker is going to market every evening and is going to say, hey, you need more money, you need more money, you need more money. So you're not going to be able to sit with it and just hope the FTSE 100 comes back. You're going to have to fund that position overnight, depending on how much leverage you're using. So anyway, I hope that explains leverage for you guys. Let me know if that's helped with a thumbs up and the comments in the comment section below. And if you haven't subscribed yet, consider doing so. See you next one. Thanks for your support. Bye-bye.